Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and it's good to have you here for this presentation. I'm going to begin by providing an overview of the stock market's performance so far in 2022, and then provide our outlook and some investment implications. Just as a brief overview to start, we are now a little more than halfway through 2022, which is proving to be a challenging year in the markets. Stocks have declined sharply due to concerns about inflation and the potential for a recession, but some measures such as unemployment near historical lows still point to a healthy economy. We will be monitoring second quarter corporate earnings results and will continue to take advantage of the broad downturn to purchase shares of companies that we believe are high-quality businesses with bright futures. The issues affecting markets in the second quarter were largely the same as in the first. Persistently high inflation, interest rate hikes by the U.S. Federal Reserve Board and other central banks, ongoing war in Ukraine, and the economic and supply chain issues related to the COVID pandemic. Stocks fell throughout the second quarter, and the S&P 500 index delivered a total return, including dividends, of negative 20% for the first half of the year. Bonds also added to losses, with the Bloomberg Barclays U.S. Aggregate Bond Index declining 10% in the first half. The Fed continued its efforts to fight high inflation by raising the federal funds rate by 0.5% in May and another 0.75% in June. The Bureau of Economic Analysis reported that U.S. gross domestic product fell in the first 3 months of the year, and there were other signs of slowing economic growth at home and abroad. New home construction cooled as interest rates and mortgage payments rose. However, consumers continued to spend, particularly on services including travel and leisure, a result of the pent-up demand related to pandemic shutdowns. So far this year, consumer discretionary, communication services, and technology stocks have led the market's declines. Investors sold shares of consumer discretionary companies due to fears about the impact on household budgets of rising gas prices and prices for other goods. After many years of outperformance, shares in technology companies corrected sharply due to investor concerns about the economy and valuation in the sector. The energy sector was a lone bright spot during the first half of the year as the price of oil surged due to supply concerns related to the Russian invasion of Ukraine and resulting sanctions. Energy shares fell toward the end of the second quarter, however, as oil prices moderated. Welcome relief to anyone who's been shocked at the cost of filling up a car lately. This current corporate earnings season should be enlightening at a critical time for the U.S. and global economies. Despite the pullback in stocks and cautionary signs regarding economic growth, analyst estimates for earnings increases in the second half of 2022 remain rather high. Corporate leaders may temper expectations on their upcoming earnings calls, causing analysts to reduce forecasts. We expect some reduction in earnings growth forecasts, but are hopeful that the outlook will be less dire than expected. The employment situation will also remain top of mind. Businesses hired 372,000 workers in June, a strong rate in line with the monthly average of 383,000 over the prior 3 months, despite recent indications that some large employers are beginning to slow hiring efforts. Total employment is currently down only 0.3% from its pre-pandemic level, and the unemployment rate of 3.6% is almost as low as the 3.5% rate in February of 2020. All eyes will also be on the Fed and its moves to tame inflation. The Fed will probably continue to raise rates into 2023, but there are some signs that inflation may have peaked despite the high inflation recently reported for June. Easing inflation would reduce the risk of recession by removing pressure on the Fed to raise rates further. COVID remains an issue, particularly as new variants appear to be more contagious than prior ones. The Chinese government's aggressive efforts to contain the spread of the virus have included ongoing lockdowns that have caused further problems with global supply chains, as have the ongoing war in Ukraine and related sanctions. Overall, we see a global economy that is struggling to maintain growth in the face of rising prices for many goods and services that threaten to curtail consumer spending. Businesses are also becoming more cautious with spending and hiring plans. However, key fundamentals such as robust employment and interest rates still near historical lows point to strength in the economy. The United States may experience a recession later this year or in 2023, but we expect any recession to be shallow and short-lived. Following the decline in prices, the stock market is more reasonably valued now, trading at about 16 times estimated earnings for the coming 12 months, as compared to 19 times at the end of the first quarter. Key to this measure is whether earnings forecasts for the coming quarters are too optimistic. Even if analysts reduce estimates over the next few weeks, we believe the market is already pricing in much of the risk of recession. We are taking advantage of the broad downturn to purchase shares of companies that we believe are high-quality businesses with bright futures. We're buying shares after a decline in their prices, a drop that we think undervalues the business's earnings prospects, particularly for those companies that can increase prices to maintain profit margins. In our opinion, these investments should provide attractive returns over the long term. Some bonds are becoming more appealing now that yields have risen, but we are wary of the potential for yields to increase further, thus decreasing the value of bonds. We still generally prefer high-yielding equities of companies such as pipeline operators, real estate investment trusts, utilities, and others that have the capacity to increase dividends or other payouts to shareholders. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions as always, and we hope you stay safe and healthy. Take care.